Here is something most Canadians never learn: $1 of Canadian dividends can be taxed less than $1 from your paycheck. Dividends are a slice of a company's profit, paid out to the people who own its shares. When a Canadian company pays what is called an eligible dividend, the government uses a gross-up and a dividend tax credit so that profit is not taxed twice. The result is a lower effective tax rate than regular employment income, especially at lower incomes. But the real magic happens inside a tax-free savings account. Hold your dividend-paying investments in a TFSA and every dividend is 100% tax-free, with no gross-up and no credit needed. In 2026 you get $7,000 of new room, and up to $109,000 if you have been eligible since 2009 and never contributed. Passive income sounds effortless, but it still takes real money invested and real time to grow. Reinvesting each dividend buys more shares, which pay more dividends, and that is compounding at work. This is education, not advice. Figures current as of 2026. Always check the latest figures with an official source.